Okay, so you want to own a shopping mall, find a big piece of land, build the thing, bring in a Macy's and a Foot Locker and 100 other stores, collect rent from all of them, watch the food court fill up on a Saturday afternoon, your name on the directory next to the map, every transaction in that building putting a small percentage back in your pocket. Thousands of people walking through your doors every single weekend, and you don't have to sell a single thing to any of them. And honestly, that picture is not wrong. It is also not the business. Here is what the picture doesn't show you. The anchor tenant, the Sears, the JCPenney, the name that fills the parking lot, is paying you roughly $4 per square foot in rent. The small boutique 3 storefronts down is paying $60. And buried inside that boutique's lease is a clause that says if the anchor goes dark, they can cut their rent in half or walk out entirely. The day Sears files for bankruptcy is not the day you lose one tenant. It is the day the financial architecture of your entire building starts coming apart in sequence. Some malls in this country still generate extraordinary wealth. Some run near full for years while quietly bleeding their owners dry. And some destroy people who never saw it coming because the warning was written in a lease clause nobody read carefully enough. By the end of this, you will understand exactly which kind you are likely to buy and why. So, let's start with what a shopping mall actually is, because the word covers more ground than most people realize. At one end, you have the Class A dominant regional mall. Think King of Prussia outside Philadelphia, or the Mall of America in Bloomington, Minnesota. These are destination properties. They draw from a 50-mile radius. Their inline tenants pay between $80 and $100 per square foot. Waiting lists for space. Vacancy rates under 5%. These malls are not dying. They are, by almost any measure, thriving. At the other end, you have the Class B and Class C enclosed regional mall. The kind built between 1965 and 1990 in mid-size American cities, anchored by department stores that no longer exist, drawing from a trade area that Walmart and Amazon have spent 30 years systematically hollowing out. There are roughly 700 of these properties still operating in the U.S. today. Estimates suggest somewhere between 200 and 300 of them will not survive this decade in their current form. Then there is the third format, the open-air lifestyle center, the mixed-use redevelopment, the former mall site that got torn down and rebuilt as apartments over retail. That is the industry's current adaptation, not its current reality. This script is about the enclosed regional mall, what it costs, what it earns, and what actually determines whether it survives. And here is the part that should recalibrate everything you think you know about this business. A mall can run at 92% occupancy and still be losing money. Not because it isn't full, because occupancy measures space that is leased, not rent that is actually flowing. Those are two entirely different numbers. And the gap between them is where mall owners quietly go broke. The entry cost for an enclosed regional mall in the United States starts, on the low end, at around $30 million for a distressed secondary market property. A functional mid-tier regional mall in a real trade area is more likely to transact between $60 and $150 million. A dominant Class A property in a major market does not come available often, but when it does, you are talking north of $500 million, sometimes considerably more. The price, though, is not the trap. Land and structure you can underwrite. Construction you can budget. Alfred Taubman, who essentially invented the modern enclosed mall's internal layout in the 1960s, understood that the physical design had to engineer foot traffic, anchor stores at opposite ends, forcing shoppers to walk the full length of the inline tenant corridor to get from one to the other. That insight made the enclosed mall the dominant retail format in America for 30 years. It also baked a dependency into the structure that would become its greatest vulnerability. But we'll get to rolling acres. What you do not see on the acquisition day are the inherited obligations. A regional mall typically carries between 40 and 90 individual leases, many of them negotiated decades ago, at rental rates that made sense in 1987. And are now significantly below market, locked in, non-renegotiable until expiration. A property you buy today might have anchor leases running to 2029 at rates as low as $3 to $6 per square foot. You cannot touch those rates. You bought them. Beyond the lease rates sit the co-tenancy clauses. And this is the inherited trap almost nobody prices in correctly. A co-tenancy clause is a provision in an inline tenant's lease that says if a named anchor store goes dark or closes, that tenant gets the right to either terminate their lease or pay a dramatically reduced percentage rent instead of their base rate. In a mall with 3 or 4 anchors and 40 inline tenants, it is not unusual for 30 of those 40 leases to contain co-tenancy clauses tied to at least one anchor. You do not discover the full architecture of those clauses until you are already inside the deal, and by then, the trap is yours. Now, the revenue side, because there is real money here. Understanding where it actually comes from matters as much as understanding where it leaks out. The base layer is base rent, the fixed dollar amount per square foot every tenant pays regardless of how much they sell. For inline tenants in a functional Class B mall, this typically runs between $20 and $45 per square foot annually. In a Class A dominant mall, that climbs to $80 or higher. An anchor tenant at the same property is paying $3 to $8. The same building, sometimes 3 storefronts apart. That spread is not an accident. Anchors negotiate from power because their name drives the foot traffic that justifies the inline tenant's rents in the first place. It is, in a strange way, a logical system, until the anchor leaves. The second revenue layer is percentage rent, and this is where the model gets genuinely interesting. Percentage rent is a clause in many retail leases that says once a tenant's sales exceed a certain annual threshold, called the natural breakpoint, the landlord collects a percentage of every additional dollar above that line, typically 1 to 7%, depending on the tenant category. A strong restaurant in a well-trafficked mall might generate a meaningful overage payment. A struggling clothing retailer never hitting breakpoint pays only base rent. The percentage rent layer can add 10 to 20% to total revenue in a good year at a healthy mall. In a declining mall, it adds almost nothing, because almost no tenant is hitting their breakpoint. The third layer is CAM charges, common area maintenance fees. This is how landlords recover the cost of heating the corridors, cleaning the food court, maintaining the parking lot, running the HVAC system that keeps 600,000 square feet at 72 degrees 12 months a year. CAM charges are passed through to tenants proportionally based on their leased square footage, and they are real money. A well-run regional mall might collect $3 to $8 per square foot in CAM annually across its inline tenants. The anchors, again, pay dramatically reduced CAM or none at all. The fourth layer almost no one factors in going in: specialty leasing, the kiosks, the pop-up seasonal retailers, the holiday photo sets, the cell phone case carts. It sounds trivial. It is not. A well-managed mall can generate between $500,000 and $2 million annually from specialty leasing alone. It is high margin, flexible, and it fills dead space that would otherwise signal vacancy to inline tenants watching their co-tenancy clauses. Here is the number that looks reassuring and is not. National mall operators regularly report occupancy rates above 90%. What that figure does not tell you is that anchor space counts as occupied even when the anchor has stopped operating but has not yet formally terminated the lease. A Sears that closed its doors in 2018 but held a lease through 2022 showed up as occupied space in the operator's filings for 4 years after the last customer walked out. The real number that matters is inline tenant occupancy. Small shop occupancy, because that is where 60 to 70% of actual rent revenue is generated, and that number frequently tells a very different story. The operating cost structure of an enclosed regional mall is not intuitive until you think about what you are actually running. This is not a building. This is a small city. The HVAC system alone on a 700,000 square foot property can run $2 to $3 million per year in energy costs. Security, housekeeping, landscaping, parking lot maintenance, roof maintenance, because mall roofs are enormous, flat, and expensive when they fail. Property insurance, property taxes, and the management fee you are paying to whoever actually runs the day-to-day. Together, these costs typically run between $8 and $15 per square foot annually across the whole property. On a 600,000 square foot mall, that is between $4.8 and $9 million per year before you have touched a single mortgage payment. The cost structure does not scale down when occupancy drops. That is the thing people do not grasp until they are living it. You cannot turn off half the HVAC because half the mall is empty. You cannot lay off half the security team because foot traffic fell. The fixed cost floor is essentially immovable, and it was calibrated to a fully tenanted building that may no longer exist. But the specific mechanism that makes this business more fragile than any single cost line suggests, the load-bearing structural weakness of the enclosed regional mall, is the co-tenancy cascade. Here is how it works in practice. An anchor tenant, say it's a JCPenney with 120,000 square feet at the east end of the mall, files for bankruptcy and closes. Within 60 to 90 days, the landlord begins receiving letters from inline tenants invoking their co-tenancy clauses. Some of those tenants are now entitled to pay only percentage rent, meaning if their sales don't hit the break point, they pay zero base rent until a replacement anchor opens. Others have termination rights they can exercise within a defined window. In a mall with 40 inline tenants and 30 co-tenancy clauses, a single anchor closure can legally reduce collectible base rent by 30 to 50% almost overnight. Meanwhile, the HVAC keeps running. The roof doesn't care. The mortgage does not renegotiate on your timeline. This is not a theoretical risk. This is what actually happened in hundreds of malls across the country between 2015 and 2022. And it is, almost exactly, what happened at Rolling Acres. Rolling Acres Mall opened in Akron, Ohio, in 1975. It was a legitimate success by every measure the industry used at the time. 850,000 square feet, 4 anchor tenants, including Sears and O'Neill's, drawing from one of the denser consumer trade areas in Northeast Ohio. Through the late 1970s and most of the 1980s, Rolling Acres ran at or near full occupancy. At its peak, it housed over 140 inline tenants. On a Saturday afternoon in 1985, it was exactly the picture described at the start of this. The first warning arrived quietly. Sears, one of the 4 anchors, began underperforming relative to its fleet by the early 1990s. Consumer habits were shifting. Big box retailers like Walmart had opened nearby, offering lower prices on the same categories Sears anchored its identity around: appliances, tools, apparel. Sears did not close immediately. It stayed on the lease. But foot traffic to that wing of the mall declined measurably. Inline tenants in that corridor watched their sales drop and began watching their co-tenancy clauses. Through the late 1990s, a second anchor, O'Neill's, was absorbed into a chain that eventually shuttered the location. The replacement tenant that moved into that space was weaker, drew less traffic, and the inline tenants nearby had already learned to read the signals. By 2000, Rolling Acres was running at around 80% occupancy on paper, a figure that, as discussed, did not reflect what was actually happening to rent revenue. Base rents on dozens of leases had already stepped down under co-tenancy provisions. The revenue picture looked substantially worse than the occupancy number suggested. In 2002, Dillard's Sears, another anchor, went dark. The cascade accelerated. Within 18 months, the mall had lost a significant portion of its inline tenants to lease terminations or negotiated exits. By 2008, Rolling Acres had effectively closed. A property that had traded at a valuation likely exceeding $50 million at its peak eventually sold for approximately $2 million, a figure so far below its physical replacement cost that it is almost disorienting to read. $2 million for 850,000 square feet of enclosed retail space. The site sat vacant for over a decade, deteriorating in the way that only large enclosed structures deteriorate when the HVAC stops and the roof begins to fail in an Ohio winter. It became one of the more photographed dead malls in the country. The cracked food court tile, the overgrown parking lot, the directory still standing with most of the names removed. In 2020, the structure was demolished. In 2021, an Amazon fulfillment center opened on the same land, a building that, in some strange way, completes the story of what American consumers chose instead. So, who actually wins in the mall business as it currently exists? Not the individual operator who bought a Class B property in 2005 believing the anchor leases were an asset. The winner is a much more specific type of entity. Simon Property Group is the largest mall operator in the United States, a real estate investment trust, which means it is structured specifically to own income-producing real estate and pass the majority of that income through to shareholders as dividends. REITs pay no corporate income tax as long as they distribute at least 90% of taxable income. Simon owns or has interests in roughly 200 properties, concentrated almost entirely in Class A dominant malls. Their properties averaged over $800 in sales per square foot in recent years, a figure that, for context, is roughly 4 to 5 times the sales per square foot at a struggling Class B mall before the co-tenancy cascade begins. The REIT structure changes the fundamental economics of mall ownership in ways a private buyer simply cannot replicate. Simon can absorb the underperformance of 1 or 2 properties across a portfolio of 200. A private owner with one mall absorbs everything alone. Simon has the balance sheet to wait out an anchor bankruptcy, replace the tenant, and hold the property through the disruption. A private owner with a 9-figure mortgage on a single asset does not have that runway. Alfred Taubman built his mall empire on the insight that physical design could manufacture destination. Simon Property Group took that insight and scaled it into a vehicle where the financial architecture is as deliberately engineered as the floor plan. The Class A mall is not merely a better building. It is a different business, one where the gravitational pull is strong enough that even in a distressed retail environment, tenants compete for the available space rather than the other way around. The people who lose this game are not foolish. They are buying the wrong format with the wrong capital structure at the wrong moment in the cycle, without fully understanding that the lease they just inherited contains the mechanism of their own undoing. Let's put real numbers on a realistic year. A functional Class B regional mall, 600,000 square feet, 75% inline occupancy. The small shops, with average inline rents of $30 per square foot, that generates roughly $13.5 million in base rent from inline tenants. Anchors at $4 across 200,000 square feet add $800,000. CAM recoveries, specialty leasing, and percentage rent overage in a decent year might bring total revenue to somewhere between $15 and $18 million. Fixed operating costs, HVAC, insurance, maintenance, management, property taxes, on a property this size, run $7 to $9 million before debt service. If the property was acquired with financing, which almost all are, debt service on a $60 million acquisition at current rates is another $4 to $5 million annually. In a genuinely good year, you are looking at $2 to $4 million of net cash flow. Not nothing, but not a large margin on a $60 million asset in a business with this much embedded fragility. In a bad year, one anchor closure, co-tenancy clauses activated, 15 inline tenants on reduced or zero base rent while you search for a replacement anchor that may not exist in your market, that $2 to $4 million turns negative, quickly, and the fixed cost floor does not move while you wait. What determines which year you get? The strength of your trade area, the age and mix of your anchor leases, and, most honestly, factors you did not create and cannot fully control, whether a Sears or a JCPenney decides your location is in the next round of closures. That uncertainty is the real asset you are buying. A shopping mall is not a rent collection business. It is a foot traffic management business disguised as a rent collection business. And the disguise works beautifully right up until the thing that generates the foot traffic decides to leave. What looked, from the outside, like a building full of tenants paying you to be there, is actually a deeply interdependent system where one departure can legally and contractually unwind the financial logic of everything else in the building. The mall that Taubman designed, and that Rolling Acres once was, and that Simon still operates at the top of the market, it is the same format. The difference is entirely in what is underneath it. Own the dominant property in a dense trade area inside a structure that can absorb the losses a single tenant creates. You are in a real business. Own the Class B mall with the inherited anchor leases and the co-tenancy clauses and the fixed cost floor and no runway. You own a timeline. The building doesn't tell you which one you have. The leases do.